What if I told you that everything you think you know about building wealth is completely wrong? That there's a hidden code operating right under your nose, separating the financially free from those trapped in the rat race forever? Today, I'm going to expose the wealth secrets that the top 1% desperately want to keep buried. Secrets so powerful that just understanding them could completely transform your financial future. But here's the kicker. These aren't complicated investment strategies or get-rich-quick schemes. They're psychological and strategic principles that anyone can master, regardless of their current financial situation. So if you're ready to crack the wealth code that's been hiding in plain sight, stay tuned because what you're about to discover will challenge everything you believe about money. Let me start with something that's going to blow your mind. The biggest lie you've been told about wealth isn't about stocks, real estate, or cryptocurrency. It's about time itself. You've been programmed to think linearly about money. Work 40 hours, get paid for 40 hours, save a percentage, repeat for 40 years. But wealthy people think in multiplication, not addition. They understand that true wealth isn't about trading time for money. It's about creating systems that generate money while they sleep, travel, or focus on what they love. This fundamental shift in thinking is what I call the time liberation principle. Poor and middle-class individuals sell their time. They might get better at their jobs, earn promotions, or even switch careers, but they're still trapped in the same paradigm. Rich people buy other people's time and talents. They invest in businesses, real estate, or assets that appreciate while producing income. They understand that there are only 24 hours in a day, but there's no limit to how many other people's productive hours you can benefit from. Think about this for a moment. When you buy a stock, you're essentially buying a tiny piece of thousands of people's daily work efforts. When you own rental property, you're benefiting from someone else's need for shelter, while your asset potentially appreciates. When you invest in a business, you're leveraging other people's skills, time, and energy to generate returns. This isn't exploitation. It's the fundamental engine of capitalism and wealth creation. But here's where most people get stuck. They think they need massive capital to start leveraging other people's efforts. This brings us to the second wealth code principle, the leverage hierarchy. There are actually 4 types of leverage, and you can start with the ones that require zero money up front. The first level is labor leverage. This means getting other people to work for your vision and goals. You don't need to be a CEO to do this. You can start a small business, become a freelancer who subcontracts work, or even create content that builds an audience. The key is shifting from being the person doing all the work to being the person organizing and directing the work. The second level is financial leverage, which is what most people think of first. This involves using other people's money to amplify your returns. But here's the secret within the secret. You don't always need banks or investors. You can use seller financing for real estate, partner with people who have capital but lack time or expertise, or even use credit strategically to fund cash-flowing assets. The third level is media leverage, and this is where things get really interesting in our digital age. Every piece of content you create, whether it's a YouTube video, blog post, podcast, or social media content, can work for you indefinitely. One video can generate income for years. One article can bring in leads forever. One social media post can go viral and change your entire trajectory. Media leverage is how regular people become millionaires in the modern economy. The fourth and most powerful level is code leverage, using technology and systems to multiply your efforts. This could mean creating software, building automated systems, or even just using existing tools more strategically. The beauty of code leverage is that it scales infinitely with minimal additional input. Now let's talk about the third wealth code principle that separates the financially successful from everyone else, the asset velocity concept. Most people think building wealth is about accumulating assets and holding them forever. But wealthy people understand that money needs to move to multiply. They're constantly recycling their capital, using the equity in one investment to fund the next, and understanding that velocity often matters more than the size of individual returns. Here's a practical example. Instead of buying one rental property and waiting 30 years for it to appreciate, a wealthy person might buy a property, force appreciation through improvements, refinance to pull out their initial investment plus some profit, then use that capital to buy the next property. They're building a portfolio while continuously extracting their invested capital to redeploy. This is how people go from owning one property to owning 50 properties in just a few years. The same principle applies to businesses. Instead of building one business and hoping it grows slowly over decades, wealthy entrepreneurs often build a business to a certain level, sell it or bring in partners to fund growth, then use that capital and experience to start the next venture. They're not attached to any single asset. They're focused on the system of wealth creation itself. This leads us to the fourth wealth code principle, the Optionality Framework. Poor people make decisions that eliminate future choices. Rich people make decisions that create more future choices. Every financial decision you make either opens doors or closes them. Wealthy people are obsessed with keeping as many doors open as possible. For example, instead of buying the most expensive house they can afford, wealthy people often buy below their means, keeping cash reserves for opportunities. Instead of getting locked into long-term employment contracts, they structure deals that give them flexibility and upside participation. Instead of putting all their money into one investment, they diversify not just across asset classes, but across different types of opportunities that could emerge. The key insight here is that opportunities are not evenly distributed across time. They come in clusters and waves. Having optionality means being positioned to take advantage of these waves when they arrive. The 2008 financial crisis created massive opportunities for people who had cash and flexibility. The COVID pandemic created unprecedented opportunities in technology and remote work. The next major shift is coming, and those with optionality will benefit disproportionately. Now let's dive into the fifth wealth code principle, and this one might surprise you, the Anti-Fragility Factor. Most people try to build wealth by avoiding risk, but wealthy people understand that some types of risk actually make you stronger and richer. They distinguish between fragility, robustness, and anti-fragility in their financial strategies. Fragile financial strategies break under stress. Having all your income from one job that could disappear overnight is fragile. Putting all your money in one investment is fragile. Relying entirely on the stock market for retirement is fragile, because market crashes can destroy decades of savings right when you need the money most. Robust financial strategies can withstand stress but don't benefit from it. Having an emergency fund is robust. Diversifying across different asset classes is robust. These strategies help you survive difficult times, but don't necessarily make you richer because of them. Anti-fragile financial strategies actually get stronger during times of stress and uncertainty. Having multiple income streams means that when one area struggles, you can focus more energy on the others that might be thriving. Owning businesses that solve problems means that during difficult times, when problems multiply, your solutions become more valuable. Having cash and credit available during market downturns means you can buy assets at discount prices. The wealthiest people in history have often made their fortunes during times of chaos, uncertainty, and apparent crisis. They understand that volatility creates opportunity, and they position themselves to benefit from disorder rather than just survive it. This brings us to the sixth wealth code principle, the Information Arbitrage advantage. In our information age, one of the biggest sources of wealth inequality isn't access to capital, it's access to high-quality, actionable information. Wealthy people don't just consume more information, they consume better information, and they act on it faster. Here's what most people don't realize. The financial advice you get from mainstream sources is designed for the masses, not for wealth building. It's conservative, slow, and focused on not losing money rather than on making significant returns. The really valuable financial information travels through different networks, industry conferences, private mastermind groups, investor meetups, and personal relationships with other successful people. But here's the democratizing aspect of our current era. You can gain access to these information networks if you're strategic about it. You can attend industry events, join online communities of serious investors, follow the actual portfolios and strategies of successful people rather than just their public statements. And most importantly, you can develop relationships with people who are already where you want to be. The key is understanding that information without action is worthless, but the right information combined with quick action can be incredibly valuable. Wealthy people have trained themselves to recognize patterns, make decisions quickly, and execute while others are still researching and debating. Let's talk about the seventh wealth code principle, the identity shift imperative. This might be the most important one because all the strategies in the world won't help you if you haven't fundamentally changed how you see yourself and your relationship with money. Most people have unconscious beliefs about money that sabotage their efforts before they even begin. Common limiting beliefs include thinking that wanting money is greedy, that wealthy people are somehow less moral, that you have to choose between money and happiness, or that you're not smart enough or connected enough to build real wealth. These beliefs operate like computer programs running in the background, influencing every financial decision you make. Wealthy people have reprogrammed their mental operating system around money. They see money as a tool for freedom, impact, and security, rather than as something scarce or evil. They understand that building wealth allows them to help more people, have more choices, and create the lifestyle they actually want, rather than just accepting whatever they can afford. But the identity shift goes deeper than just beliefs about money. Wealthy people think of themselves as investors first, regardless of their day job. They see every dollar not as something to spend, but as a seed that could grow into more dollars. They think in terms of ownership rather than employment, systems rather than tasks, and long-term compound growth rather than short-term consumption. This identity shift affects everything: what they read, who they spend time with, how they structure their day, what risks they're willing to take, and most importantly, what they believe is possible for their future. You can't outperform your self-concept, so changing how you see yourself is often the first and most crucial step in changing your financial reality. The eighth wealth code principle is the network effect multiplier. Your network truly is your net worth, but not in the way most people think. It's not about knowing rich people who will give you money. It's about being part of communities where opportunities, information, and resources flow freely among members who are all committed to mutual success. Wealthy people understand that collaboration beats competition in the long run. They're constantly looking for ways to create win-win scenarios where everyone benefits. They share deals, refer business to each other, partner on investments, and pool resources for opportunities that would be too big for any individual to handle alone. But here's the key. You can't just take from these networks. You have to contribute value first. This means developing skills, resources, or connections that would be valuable to others in the network. It means being generous with your knowledge, your time, and your opportunities. It means following through on commitments and building a reputation for reliability and integrity. The beautiful thing about networks is that they compound over time. Each person you help successfully is likely to help you in the future and refer other valuable people to you. Each successful collaboration makes future collaborations more likely and more lucrative. Over time, you become someone that opportunities flow toward, rather than someone who has to chase after every possibility. Now let's discuss the ninth wealth code principle, the tax optimization system. This is where wealthy people often have their biggest advantage, and it's completely legal and ethical. The tax code is actually designed to incentive certain behaviors that create jobs, provide housing, and stimulate economic growth. Wealthy people align their financial strategies with these incentives. For example, the tax code rewards real estate investment through depreciation deductions, which can often eliminate most or all of the tax on rental income. It rewards business ownership through multiple deduction opportunities that aren't available to employees. It rewards long-term investing through lower capital gains rates compared to ordinary income rates. The key insight is that wealthy people make financial decisions with tax implications in mind from the beginning, not just at the end of the year. They structure their investments, their business entities, and their income streams to minimize tax drag on their wealth-building efforts. They understand that it's not just about how much you make, but how much you keep after taxes. This doesn't require illegal tax avoidance or complex offshore schemes. Most of the tax advantages used by wealthy people are available to anyone willing to learn about them and structure their affairs accordingly. The difference is that wealthy people either learn this information themselves or pay professionals to help them optimize their tax situation. The 10th and final wealth code principle I want to share is the legacy leverage system. Wealthy people think beyond their own lifetime. They're building systems that will continue to generate wealth and impact long after they're gone. This long-term perspective fundamentally changes how they make decisions in the present. When you're thinking about creating generational wealth, you can't just focus on get-rich-quick strategies or short-term gains. You have to build sustainable systems that can survive economic cycles, market downturns, and changes in technology or regulation. You have to create businesses, investment portfolios, and knowledge systems that can be passed down and continued by others. But here's the counterintuitive part. Thinking about legacy actually makes you wealthier in the short term too. When you're focused on building something lasting, you make better decisions. You're more likely to invest in quality assets, build genuine relationships, create real value for others, and develop systems that can scale beyond your personal involvement. Legacy thinking also creates what I call the infinite game mindset. Instead of trying to win individual financial transactions, you're trying to stay in the game and keep creating value indefinitely. This makes you more trustworthy, more collaborative, and more attractive to other people who are also playing the infinite game of wealth building. So there you have it, the 10 wealth code principles that separate the financially successful from everyone else. Time liberation, leverage hierarchy, asset velocity, optionality framework, anti-fragility factor, information arbitrage, identity shift, network effect, tax optimization, and legacy leverage. These aren't just abstract concepts. They're practical frameworks you can start implementing immediately. But knowledge without action is worthless. The difference between people who watch videos like this and people who actually build wealth is execution. Start with one principle that resonates most with you. Maybe it's beginning to think about how you can leverage other people's time instead of just selling your own. Maybe it's joining a community of like-minded people who are serious about building wealth. Maybe it's simply changing how you think about yourself and money. The wealth code isn't really hidden. It's hiding in plain sight. These principles are being used by millions of successful people around the world. The only secret is that most people either don't know about them or don't take action on them. Now the question is, what are you going to do about it? Your financial future starts with the very next decision you make. Choose wisely.